Marginal costing. Marginal costing is a technique of cost and management accounting which is used to analyze relationship between cost, volume and profit. In order to appreciate the concept of marginal costing, it is necessary to study the definition of marginal costing and certain other terms associated with this technique. Introduction to marginal cost. Marginal cost, as understood in economics, is the incremental cost of production which arises due to one unit increase in the production quantity. As we understood, variable costs have direct relationship with volume of output and fixed costs remains constant irrespective of volume of production. Hence, marginal cost is measured by the total variable cost attributable to one unit. Marginal cost can precisely be the sum of prime cost and variable overhead. Marginal costing is a costing system where products or services and inventories are valued at variable costs only. It does not take consideration of fixed costs. This system of costing is also known as direct costing, as only direct costs forms the part of product and inventory cost. Costs are classified on the basis of behavior of cost, i.e. fixed and variable, rather functions as done in absorption costing method. Direct costing and marginal costing is used synonymously at various places, and it is so also. But the relation of costs with respect to activity level must be understood. Some costs are variable at batch level but fixed for unit level, and likewise variable at production line level but fixed for batches and units. Let's talk about differential and incremental cost. Differential cost is difference between the costs of two different production levels. It is a relative representation of costs for two different levels, either increase or decrease in cost. Incremental cost, on the other hand, is the increase in the costs due change in the volume or process of production activities. Incremental costs are sometimes compared with marginal cost, but in reality there is a thin line difference between the two. Marginal cost is the change in the total cost due to production of one extra unit, while incremental cost can be both for increase in one unit or in total volume. Characteristics of marginal costing. The technique of marginal costing is based on the distinction between product costs and period costs. Only the variables costs are regarded as the costs of the products, while the fixed costs are treated as period costs which will be incurred during the period regardless of the volume of output. The main characteristics of marginal costing are as follows. All elements of cost are classified into fixed and variable components. Semi-variable costs are also analyzed into fixed and variable elements. The marginal or variable costs, as direct material, direct labor and variable factory overheads, are treated as the cost of product. Under marginal costing, the value of finished goods and work in progress is also comprised only of marginal costs. Variable selling and distribution are excluded for valuing these inventories. Fixed costs are not considered for valuation of closing stock of finished goods and closing WIP. Fixed costs are treated as period costs and are charged to profit and loss account for the period for which they are incurred. Prices are determined with reference to marginal costs and contribution margin. Profitability of departments and products is determined with reference to their contribution margin. Facts about marginal costing. Marginal costing is not a distinct method of costing like job costing, process costing, operating costing, etc., but a special technique used for managerial decision making. Marginal costing is used to provide a basis for the interpretation of cost data to measure the profitability of different products, processes and cost centers in the course of decision making. It can, therefore, be used in conjunction with the different methods of costing such as job costing, process costing, etc., or even with other techniques such as standard costing or budgetary control. In marginal costing, cost ascertainment is made on the basis of the nature of cost. It gives consideration to behavior of costs. In other words, the technique has developed from a particular conception and expression of the nature and behavior of costs and their effect upon the profitability of an undertaking. In the total cost method, as opposed to marginal costing, the classification of costs is based on functional basis. Under this method, the total cost is the sum total of the cost of direct material, direct labor, direct expenses, manufacturing overheads, administration overheads, selling and distribution overheads. In this system, other things being equal, the total cost per unit will remain constant only when the level of output or mixture is the same from period to period. Since these factors are continually fluctuating, the actual total cost will vary from one period to another. Thus, it is possible for the costing department to say one day that an item costs 20 and the next day it costs 18. This situation arises because of changes in volume of output and the peculiar behavior of fixed expenses included in the total cost. Such fluctuating manufacturing activity, and consequently the variations in the total cost from period to period or even from day to day, poses a serious problem to the management in taking sound decisions. Hence, the application of marginal costing has been given wide recognition in the field of decision making. Advantages and limitations of marginal costing. Advantages of marginal costing. Simplified pricing policy. The marginal cost remains constant per unit of output whereas the fixed cost remains constant in total. Since marginal cost per unit is constant from period to period within a short span of time, firm decisions on pricing policy can be taken. If fixed cost is included, the unit cost will change from day to day depending upon the volume of output. This will make decision-making task difficult. Proper recovery of overheads. Overheads are recovered in costing on the basis of predetermined rates. If fixed overheads are included on the basis of predetermined rates, there will be under recovery of overheads if production is less or if overheads are more. There will be over recovery of overheads if production is more than the budget or actual expenses are less than the estimate. This creates the problem of treatment of such under or over recovery of overheads. Marginal costing avoids such under or over recovery of overheads. Shows realistic profit. Advocates of marginal costing argues that under the marginal costing technique, the stock of finished goods and work in progress are carried on marginal cost basis and the fixed expenses are written off to profit and loss account as period cost. This shows the true profit of the period. How much to produce? Marginal costing helps in the preparation of break-even analysis, which shows the effect of increasing or decreasing production activity on the profitability of the company. More control over expenditure. Segregation of expenses as fixed and variable helps the management to exercise control over expenditure. The management can compare the actual variable expenses with the budgeted variable expenses and take corrective action through analysis of variances. Helps in decision making. Marginal costing helps the management in taking a number of business decisions like make or buy, discontinuance of a particular product, replacement of machines, etc. Short-term profit planning. It helps in short-term profit planning by B.E.P charts. Limitations of marginal costing. Difficulty in classifying fixed and variable elements. It is difficult to classify exactly the expenses into fixed and variable category. Most of the expenses are neither totally variable nor wholly fixed. For example, various amenities provided to workers may have no relation either to volume of production or time factor. Dependence on key factors. Contribution of a product itself is not a guide for optimum profitability unless it is linked with the key factor. Scope for low profitability. Sales staff may mistake marginal cost for total cost and sell at a price, which will result in loss or low profits. Hence, sales staff should be cautioned while giving marginal cost. Faulty valuation. Overheads of fixed nature cannot altogether be excluded, particularly in large contracts, while valuing the work in progress. In order to show the correct position, fixed overheads have to be included in work in progress. Unpredictable nature of cost. Some of the assumptions regarding the behavior of various costs are not necessarily true in a realistic situation. For example, the assumption that fixed cost will remain static throughout is not correct. Fixed cost may change from one period to another. For example, salaries bill may go up because of annual increments or due to change in pay rate, etc. The variable costs do not remain constant per unit of output. There may be changes in the prices of raw materials, wage rates, etc. after a certain level of output has been reached due to shortage of material, shortage of skilled labor, concessions of bulk purchases, etc. Marginal costing ignores time factor and investment. The marginal cost of two jobs may be the same, but the time taken for their completion and the cost of machines used may differ. The true cost of a job which takes longer time and uses costlier machine would be higher. This fact is not disclosed by marginal costing. Understating of WIP. Under marginal costing, stocks and work in progress are understated.